Hi, everybody. Welcome to the latest episode of the Scaling Alpha podcast. I'm Ben Webster with Revella, and today I'm joined by Akshay Rao, co-founder and portfolio manager at Strivepoint Capital. Akshay's firm operates on a compelling premise that a structural inflection point is not a cyclical bounce, but a fundamental rewiring of a company's economics. And that narrative lag ensures the broader market is almost always too late to see it. Combining an investigative research approach with operator level unit economic analysis and macro trend scouting, Strivepoint targets companies at their critical turning points before new realities are priced into the market. Today, we're going to dive into how Akshay built this fundamental process, how his team evaluates business quality, and how technology is altering institutional research. Akshay, welcome to the show.
Great to be here, Ben. Excited to share all that we're doing.
Well, thank you so much for joining us. So to kick things off, tell us about where you're from and kind of your early journey throughout your childhood and your career that led you to where you are now today.
Absolutely. So I grew up in Mumbai, in India, born and raised in that urban environment. I come from a fairly what you would consider middle-class family. Parents had a big role in kind of shaping, my outlook back then and even now. So, as most people would experience this as an only child. So, right at when I was probably 6 or 7 years old, I used to see these books under the coffee table by, Charlie Munger or Buffett or someone covering them. And I used to ask my dad, like, what is this all about? It took me a couple more years to understand fully what he was telling me. But I think I learned about the value of investing as just a life skill quite early. I was really thankful for that. And, he used to often make the point of communicating that, you live within your means, you save up, the cash that you don't need and you invest that so that, money works for you rather than the other way around. So that was a very important lesson for me, which I've kept, with me till date. And simultaneously, I think my mom always, I used to go shopping with my mom a lot. And so, buying stuff for the family or just gift for other people. And the big takeaway was you never pay list price. So that the combination of those two kind of influence a lot about how I think about, taking decisions in life, including investing.
Yep. So do you know how your dad got interested in investing?
I think as most people would say, necessity is the mother of invention.
Yep.
I think he grew up in Bangalore, which is a different city in India, and he came, to the city for education. He was trying to become a CPA, or in India we call it a chartered accountant, and all he had with him was like a suitcase and the shirt off his back. And so for him, his relationship with kind of money was fairly different. It's just like, can I get food, shelter, and clothing? And over time he realized that he was in a much better position where he was living within his means and he had a lot of that cash. And I think he was influenced by people around him as well as the economic boom that India was supposed to go through. And I think that drove him to kind of evaluate the capital markets when he was a young man. And I think he just started doing that. It worked for him, and he had been an investor ever since I remember. I think even when, he had progressed quite further and, joining senior leadership of different companies in India, like I would say that he focused a lot on investing as a very important thing as he thinks about, all his professional goals. So I would say the influence came through kind of putting himself in the right set of people, sometimes personal circumstances. And I think that led him to, be a pretty prolific investor.
That's fantastic. So investing is in your DNA per se.
Somewhat.
Yeah. So here you are, a young boy, then transitioned to young man. You're interested in investing. Tell us about where'd you end up going to university and kind of your early career journey.
Yeah. So I would say that I was always a student of science growing up. So I loved the quantitative aspect that science offers. It gives you a very interesting outlook and problem-solving toolkit. So for undergrad, I pursued engineering. Specifically, it was like a combination degree between chemistry and chemical engineering in the Indian Institute of Technology, Guwahati. So that's in the northeast of India, which is an amazing experience for me to kind of, stretch my arms a little bit, try different things. But, there was a point in time where I did consider going to CERN or Fermilab and becoming a particle physicist. That's a whole different story.
I actually had a physics degree from UCLA. So
That's amazing.
then I went into finance, but yeah, so it's somewhat of a similar trajectory there.
Yeah, and so I was doing some work, like my thesis work in undergrad was around a certain type of lasers. And so, I experienced my first ever scientific computer back in the day, and I was coding in Fortran and some obscure languages. But, those days you didn't have the cloud, right? And so you got this massive black box that you're running code on. So I really enjoyed that experience. But, I always thought, the challenge with research, at least, me, then a 21-year-old thinking these ideas, the challenge in research was that it takes a long time to actually see your idea get to, deliver outcomes for regular human beings. And I pursued an internship in business, and I felt much more rewarded because the outcomes were on shorter timelines rather than, decades. And so I ended up making the decision that I like this problem solving. The tools that I developed as an engineer apply quite well to the business context. In the sort of first principles thinking. So I ended up joining a strategy consulting firm in Mumbai, immediately after graduating, and enjoyed that experience. Spent a lot of time in certain set of industries, specifically banking and life sciences. So a lot of pharmaceutical companies, both domestic Indian companies as well as like sort of global companies. So that was a bunch of fun for me. And then in 2014 is when I decided to leave strategy consulting and actually get my hands dirty, so to speak, and help build a small company.
So I think you mentioned a data analytics or a data visualization company.
Yeah, I back then we used to refer to ourselves as something at the intersection of Tableau and Palantir. Not Palantir now, but Palantir back then. So we were doing data visualization, primarily serving both enterprise customers who are kind of trying to build a business intelligence stack, or news media organizations that were trying to create more engaging content for their online readers. So we built a lot of visualization focused technology. We were doing a lot of consulting work, but I think the more important kind of lessons I took away from that is, how hard is it, and how and occasionally how rewarding it is to actually build a company from the ground up. And it really offered me the opportunity to kind of build my operational chops. You kind of wear multiple hats. One day you're the PM, product manager. The other day you're the sales guy, and you got to like know how to flexibly move and know what is the right way to communicate, whether it's with your development team or with a potential customer. So I think that taught me a lot beyond the context or the sandbox of just being a strategy consultant and telling people what to do. But now the onus is on you to kind of take on that risk and kind of deliver the outcomes.
Do you think that helped you, along with obviously other probably developments and learnings in your career, to be able to assess a company's management better in some way, shape, or form?
I'd say so. Both sort of the strategy consulting part as well as the sort of startup twist, they help me a lot in kind of what does it take to actually, you put a number on a page, how do you make that number real? What are the execution missteps that can lead you to the right or wrong direction? I think it taught me a lot about that. And I think more importantly, I think it really reinforced my entrepreneurial DNA that I want to eventually at the right point in time, set up something of my own. So I think that experience really helped me a lot in like creating Strivepoint Capital as it is today.
Got it. So take us from the data visualization company to how you end up actually becoming an investor and working in investment.
I think the immediate journey after, the data visualization startup was me coming to the US. So I applied for business school, felt the timing was right for me, and I'd got in, but I had like a lot of time in my hands. And so I was like, instead of going for a trip, is there something that I can kind of engage in that would be quite valuable for me long term? Back then I used to think about businesses as having 4 pillars, like the act of business having 4 pillars. There's the strategy, there's the execution or operations part, there's the capital part, and then there's the legal side of things. I was fairly sure I did not have a natural preference to go to the legal side. So, and I'd already done strategy and operations, but capital was a missing piece professionally for me.
Mm-hmm.
So I spent the next couple of months at an investment shop. They had a private equity arm as well as a hedge fund.
Was after your university here in the United States, or was it
No,
while
this
you
is
were at school?
before.
Oh, before.
It's before. It's like when people were going on summer vacation, I was looking at deals that
Got it.
bankers were getting us on the private equity side. But
Mm-hmm.
but I think that was a fairly important. I may not have learned as much as working there full time, but it was a very, very important experience, as you all know, because it was, I think, on the first or second day of my internship, I met this guy in sort of the lunch canteen, and we started talking about investing. We were super engaged about it. We both appreciated the idea of capital markets as kind of a universal equalizer for people who come from all walks of life. And today, that person I met, this is to be like the summer of 2017, so it's a while back. But that person is basically my co-founder and Co-CIO at Strivepoint. So we've had a pretty long lasting friendship through that period. But yeah, a lot of learnings in the US also that kind of served as a aha for me.
So
And
this was like the first time you were actually looking at companies as potential investments and looking
yes.
at it and dissecting it from an investment lens.
Yeah, as an investor, as a capital allocator, it's a completely different lens. And I think, I'd not had direct exposure to that yet. And I think that experience over the next couple of months really helped me gain an insight into, okay, this can be quite different than, how an operator would think about it, or how, a chief strategy officer would be thinking about a business.
Got it. So tell us, what school did you attend here in the United States?
Yeah, I was at Yale.
Nice.
So I was in Yale School of Management, and obviously you pick 5 or 6 and you end up at one. But I think what I really appreciated is the experience at Yale really allowed me to learn the different facets on styles of investing. So I pretty much, I think by semester 2 and semester 3, I had like an overloaded coursework. So I was in classes that had to do with fundamental investing. I was in a behavioral finance class. I was in a quant finance class. And so, I think as a physicist, you'll appreciate this analog, but I was always in like, is it a wave or is it a particle? Because you've got these two schools of thought on the fundamental and quantitative side, but they're looking at the same assets and prices. So they've got to kind of come together in some form or shape. And that's been my just general kind of journey in investing is, how to gain the best from, a fundamental lens, thinking about the behavioral lens, thinking about the quantitative or factor lens, as some people would consider it, to ultimately have all the kind of, shapes of the elephant from that old adverb.
Yeah, no, that's fantastic. So from my understanding, after you graduated from Yale, you went and worked for a hedge fund, right?
No, I was actually at a strategy consulting firm.
Okay.
Which I was part of their private equity practice. So
got it.
It made sense from a natural transition, since I'd spent a lot of professional experience in consulting. But I really loved kind of being close to the capital allocators, whether in the public or private side. So a lot of my work focused on consumer private equity. So these would be private equity divisions or full-on firms that typically acquire consumer packaged goods or retail brands, things of that nature. Because I love consumer. It was like a new thing I discovered. That, it's always fun to look at companies that you use or you are a consumer of yourself, and then kind of using that as a springboard to understand how does the business actually function.
Got it.
Spent close to 5 or 6 years across, multiple funds, the whole deal life cycle, right from, setting up the top of house strategy at these firms to buy side diligence, portfolio growth. So how do you grow the company once you bought them, and then sort of exit support. Saw that whole life cycle. But, the one thing that always struck me is that, through those dozen or so sort of studies that I'd engaged in, my intuition and my, analytics on, what a good company looks like and what a bad company or a bad result looks like was pretty spot on in most cases. However, I had no skin in the game as a consultant at the end of the day. And so I think that was an important realization for me, is that if I'm able to maintain that level of sort of win rate in investing, would it make more sense for me to actually put some skin in the game?
Yep.
And I think
So
that
so
really
so
got this.
that's and when you have your own skin in the game, it does affect how decisions are made, right?
Exactly.
But we'll circle back to that. So you spent 5 or 6 years at this consulting firm. Is Strive the next thing, or did you do
Yes.
work somewhere else? So
Yeah.
Strive was the next thing.
Yeah.
So
So we
tell
came
us
in.
about the founding of
Yeah.
Strive.
So
Strive Point,
Strivepoint
excuse me.
came to be through me and my co-founder Sambodhi. So, we met back when I was an intern. Very serendipitously, we had a very similar journey to the US. I was at Yale, he was at Columbia. Both of us ended up at the same strategy consulting firm. And then, we were always talking about investing, right from the day we started. And I think in sort of the early half of 2024, it was almost like the planets aligned for us in terms of, hey, we'd always talked about, one day we'll set up our own investment fund. And if there was ever a time to, strike the iron when it's hot, it was that year. So ultimately, we ended up, talking to a bunch of, our mentors, friends, family members on making a pretty significant decision to start a company, and especially a hedge fund, which has naturally higher sort of mortality rate, so to speak. But we got a lot of positive encouragement and support. And I remember one of my very close mentors at the firm. I'd gone to him and I'd told him, hey, I'm planning to leave. I'm thinking of starting this thing. And he basically told me, that is awesome. And how much do you need, and where do I sign?
Wow. So he
So
must have really had a high respect for your professional capabilities.
yes, I think his that conversation was fairly important for me, because you don't really have much signals when you're starting a new business. And that, while he may have done that to support me, I think the impact was much larger, because it gave us also a lot of confidence. Okay, there is really something here from the get-go, and we don't need to wait for validation long, couple of years, which is typically the path for most emerging managers.
Yep. So tell us about Strive Point. Take us through kind of the fundamental pillars of how you look at the financial markets and investing.
Yeah, I think you covered it up front. So Strivepoint Capital is a global equity investor
Yep.
that invests in any public markets company outside the S&P 500. So that's the only universe we don't touch. Everything in the US, in other global markets is kosher. We are specifically investing in theme sectors or companies that are undergoing structural inflection. And the simple way that we describe structural inflection is that the historical kind of earnings and revenue growth of the company no longer are representative of what the future beholds. Now, obviously, as part of that, we need to do a lot of groundwork in defining why is it different going forward, and
Mhm.
then what makes a candidate company the best place to park our capital.
Yep.
And that's when, happy to dig into our entire process. But that's basically how we invest. We currently have 6 investment themes that we've defined as, where we are fairly constructive, and that's
Mhm.
how we allocate.
So let's, I have an understanding that you're kind of looking at a top down to find investment themes, right? And then from there, you're looking at individual companies that are operating within those themes to see. Okay, so tell us about. Let's first talk about the themes and how do you identify those themes?
Yeah. So I think a big bet, when we started the fund, I wouldn't say we had extreme clarity on how we, had a very simple process and systematic process to define the theme. I think the last 2 years has taught us, as well as the rest of the world, that we are in a fairly inflective environment with sort of the emergence of AI, the eventual adoption of, inference AI, agentic solutions out there, potentially getting into, robotics and some of the other vectors over the next decade. It told us that the world is changing pretty quickly. Second thing is, we are also seeing kind of realignment of geopolitical relationships, whether you want to think about sort of, the tariff months from early last year to the conflict in the Strait of Hormuz. Sort of allies are getting reshaped, borders redrawn, and a whole bunch of volatility. So as we saw those things happening, given my science background, I went immediately to entropy and the degrees of freedom. And so it kind of, while it did not necessarily inform our original view of being global equity managers, I think it supported that. So we wanted to give ourselves more optionality, right? I personally believe that, just being invested in the United States, because that's only what seems simple, because there's compliance requirements to go outside, is something we can easily, jump over. As an institution, we felt that you don't need to be locked into a geography, that, if you expand the number of degrees of your freedom, you can You can often find great value investments in Latin America or Canada or Europe. And so I think that using that flexibility as an alpha was fairly important and kind of reinforced by some of the events that we've seen over the last 2 years. So to your original question, so what we start off with is kind of having what we call our worldview. Now, how does the world look like 1 year from now, 3 years from now, 5 years from now? And what are the key drivers at the global stage or from the private sector that is influencing the world to look a certain shape? That helps us figure out the kind of investable themes that we see as the most promising. As a quick example of some of our current themes, whether it's sort of beneficiaries in the AI build out super cycle on the infrastructure side, on the application side, sort of energy security, spanning, I would say, even not just energy, but energy and critical resource security that we're currently seeing. American dynamism, which is a term we kind of co-opted from Andreessen Horowitz, but I think it still applies, is reshoring of American manufacturing know-how from a national security standpoint to something that's more resilient consumption. As we continue to see some form of a K-shaped economy kind of evolving in the United States, what kind of consumption would be fairly resilient? And some disruptive trends that we see in sort of financial services and healthcare. So those kind of sum up the six things that we defined earlier this year as being the most promising for us. Once we kind of define the themes, I would say most of our screening and investment diligence process is fairly GARPy in nature. So we're looking for a reasonable multiple, so still value oriented. We're looking for strong earnings growth, defined either in EBITDA, earnings per share, or free cash flow. And we're looking for, signs of it being a high quality business that is not just from a numbers perspective, but who's running the company, what's their leadership track record, are they the right people for the current job or the requirements that the company really needs to experience that inflective growth. So that's where, our kind of combined experience in sort of finance and spending some time running businesses really, spikes up our abilities.
No, thanks for that overview. This actually begs the question though, right? So you've identified this, you've created this worldview, right? And you've identified these significant trends that you believe that if you find the right companies, you can capitalize on those trends. But you're also looking for a structural inflection, right? Not a cyclical bounce. That would presuppose that this isn't necessarily a company that was founded to take advantage of these trends, but had an existing business before, but is set up in such a way or making decisions and of assets that they have that allow them to take advantage of this new trend. Am I reading between the lines correctly?
Right. I think that is right. So I think typically when we think about structural inflection, there are two types of companies that show up. One is where, it was a legacy business doing something, that it's been doing for maybe a decade, maybe 2 decades, maybe more. But suddenly what it makes is super relevant for at least a medium, if not long-term kind of time horizon. So when I say medium, I'm thinking like 5 years, long-term, I'm thinking 10 years. So, you're seeing a lot of industry, just a quick example, you're seeing a lot of industrial companies kind of being prime beneficiaries of all this AI infrastructure and build out, right? Now, not all of them would fall into our successful screening criteria, but some of them are businesses that were really good businesses. They were not super hyper growth businesses previously, but now have a good runway of the next 5 to 7 years that we can, ascertain as really, really productive periods for earnings growth. So that would be an, business that's inflecting. Sometimes sometimes as you often think about in startups, sometimes it's not that the technology is wrong, it's just your timing is wrong. And so, there might be companies that started with the intention of doing something in the markets, but their product wasn't really relevant in the larger scheme of things. So occasionally we'll find companies, whether it's a unmanned aerial vehicles or a drones company that was been around for a couple of years, but the US Army wasn't really buying drones back then.
But now they are.
Yes.
Yep. So the inflection point could be assets and that are repurposed for these opportunities, or assets that pre-exist that were aligned with these opportunities, but pre-existed before the opportunity existed to this scale.
Yeah, and I think an analog way of thinking about it would be like a chessboard, right? So we're not playing attacking chess here; we're playing positional chess for any chess players listening in. But sometimes it's not just what the company is doing that influences the structural inflection. It's the overall, how is the position of the chessboard set up. And that's why it's so important to have that worldview, because, you might be right on the theme, but if the world is not moving in the direction where your theme is relevant, you might end up with a company that does not really inflect.
That makes a lot of sense. I've read, everything I can find on your company prior to this call. One thing I found is that you cited Robert Shiller's work on narrative economics to explain why consensus mispricings occur due to narrative lag and anchoring bias. Tell us about that and how, companies that are typically pursuing that way of thinking are structurally blind to these transitions that you're looking for, that you're looking to exploit.
I think narrative economics really talks about patterns that drive sort of boom bust cycle. Sometimes it drives where capital moves without necessarily like capitulating in a bust. I think that the companies that we've seen in the previous sort of era of investing, which is, I guess, pre-COVID era, they benefited a lot from just great, access to capital markets. And, all you needed was the ability to show consistent earnings growth. You didn't really need to have a story. And sometimes those companies were buying, targets with, and essentially empire building, buying revenue, buying earnings. And so, you get these, you get earnings growth, but you don't really get like what is your role in a larger sector and a larger industry, and are you set up for successfully making any transitions if they happen, right? And I think if with AI, it's becoming fair. I would reckon and say that most software companies knew AI was coming. ChatGPT is around for long haul, but it took the event that, Claude goes out and releases Cowork or more features, and suddenly you have this massive kind of reevaluation of the value of software companies, since October of last year. So that is a case where the writing was on the wall, but sometimes if you're solely focused on financial performance, you might end up being too focused on a whole, and you're not seeing how the picture of the general landscape is changing. And this is me purely speaking of it as an operator, not just as an investor. It's kind of important that you know what's going to, substitute you in a couple of years.
Well, we have a saying here: you don't want to lose the forest through the trees, right?
Yes.
And so you're just focused on that one company and its operational performance and trying to figure out if the existing patterns that have been in place for multiple years are going to continue. You got to look at the overall, as you would say it, worldview.
Yeah.
So once you find an inflection point, right, and that inflection point is confirmed in the market, right, others are becoming aware of the inflection point. I've read that the way you look at it is that, and what you've seen is that the re-rating of that company is often nonlinear. Years of value creation could be compressed into weeks.
Yes.
How do you make sure that you obviously that you can take advantage of that, right? But also, capture the asymmetric upside, but prevent any of the quick downsides that could happen after that's been priced in?
Yeah, that's a good question. I think it comes down to some combination of science and judgment. So, I remember one of our investors early in our life cycle has asked us, like, how do you know that you're not selling at too cheap a price?
Yep.
And so I think that there's no right answer there in terms of like as any investor before me and after me will say, none of us have a crystal ball. Like, we don't know for sure what's going to happen. But I think you're making a certain disciplined kind of expectations of how your portfolio or how a position should perform. So we take a very, process-oriented approach. So it's, our expectation is overall, we are trying to build a portfolio of positions that delivers 25 to 30% of IRR over 3 to 5 horizons. So that's our goal. Right. And sometimes we might be too greedy if the risk is low. Sometimes if the risk is high, we're going to, take our profits and find something else to do with that capital.
Yep.
So I think
as long as you have a good hit rate to finding new opportunities, right? Like, I've read somewhere that, doing some research, I find that the average investment analyst, not a rookie, experienced investment analyst, has a 55 to 60% fundamental, 55 to 60% hit rate. But one of the biggest degradations of alpha is selling too early.
Yeah.
And the other degradation is not recognizing your losers too early, right? And so, but if you could keep on finding new ideas, I guess good ideas, selling early is not as bad as it would be if you were replacing it with losers, obviously, right?
Yeah. It's funny you say that. I think our success rate is probably in the 70s right now. So it's only going to go downhill from here.
So one of the things that ensures I shouldn't use the word ensures, right? There's no promises made of any type of return that you are making or I am making about anybody I bring to this podcast. But one of, I'm sure, the key skills is evaluating management. Tell us about your approach to evaluating management and what you're looking for from a team to quantify whether a team is a good management team for the company they're running.
Yeah. So right from this get-go, we do like founder-driven businesses. I think there's, at the end of the day, all of that boils down to like dealing with the principal agent problem, right? Us, shareholders being the principal, the leadership being the agent in this context. And so as we're trying to get sharper on that problem, founders have deep incentive of growing and creating something super valuable for themselves. When it's not that case, you're looking for a professional track record that aligns with our investment thesis in a company. So is this person just job hopping, every 2-3 years as a, CXO, or is this person been around when things are not that great for the company, and have they helped navigate those companies through those transformational periods? You're looking for a skin in the game, right? Is management rewarded? Are they incentivized to drive, enterprise value north of where it is today? You're looking for signals that they continue to stay invested, right?
Yeah.
So when excluding some other reasons why there's insider selling, you don't want to see them actively like sharing their ownership, because if it's not systematic, it's not generally a great sign that you're invested for the right reasons, similar to me. And so I think that those are the more financial reasons. But then you start looking at the operational track record, right? Projects that you announced 5 years ago that still exist today. What's the ROI that you kind of generated on it? How did it add value on an earnings or revenue perspective? How many projects did you cancel? I think there's a sweet spot. You got to, if things are not going bad, you're not trying hard enough sometimes. And
Yep.
so, you're finding that balance where they are trying to find, new avenues to grow the business. They are focusing on their core with the right kind of mind share. And
Mm-hmm.
they're in here for kind of, I want to hear more retirements rather than resignations,
Yep.
putting it in a simple framing.
That makes a lot of sense. And and you have to base it on, again, data that you can discover, right? And in their past resumes, how are those companies doing when
Yeah.
they were at those firms? And so you have it sounds like you have a very disciplined and to the extent that you can do it, rules-based process in
Yeah, we
evaluating
have like
management.
what we call our 100-point scorecard of
Hmm.
like, which looks at everything from sort of how valuable is the product or service this company is providing to their customers, to, management quality, to the financials, to the, competitive positioning. So we look at every gamut of what could matter to the value that this company is creating. Both sort of tangibly, measurably in terms of finances, as well as the intangible or less, more sort of balanced qualitative and quantitative approach. So each of our companies gets a score out of 100, and then we have a similar kind of measurement tool for risk.
Fantastic. Well, one of the things I learned reading about Strivepoint was that one of the disciplines that is very important to you is investigative journalism, right? And taking that viewpoint to gather signals at the edge, what you call the edge of the ecosystem, from suppliers, customers, fringe competitors. I'm assuming that's part of your scorecard. Tell us what you're looking at there when you're trying to look at the edges of the ecosystem
Yeah, I
and
think
how
we're
you
just
evaluate that.
trying to find information that we would have missed that don't exist in filings, right?
Yep.
So, if you just look at the 10K, you can learn a lot about a company. You can learn a lot listening to their earnings calls, but then talking to, formers who are willing to speak in sort of a general flavor of what they think about a company, whether it's talking to suppliers and customers from a sort of channel check perspective, whether it's learning from other buy side investors who have a different read on a company than you. I think all of
Hmm.
that matters, and it kind of flows into your signals kind of framework. We internally, I think we've spoken about it on our website, but we have what we call our different types of intelligence, right? From sort
Hmm.
of signals intelligence, financial intelligence, which are the more obvious ones. You can go and see how many unique users are hitting a website quite easily, and you can also figure out the financials. But when it comes to geo intelligence, when it comes to sort of human intelligence by speaking to experts, so we have a very structured way of how we capture those signals, and how do we utilize that piece of information while we are building our thesis. And that's not just important for the thesis before investing, but I think the idea of a thesis is a set of things that need to go right and that you need to check and reinforce on a regular basis. So we are constantly asking ourselves, at regular intervals of time, does the core pieces of our thesis still hold? Is the data still supporting the directionality of move, right? And that's important. I think the direction sometimes is actually more important than the order of magnitude, because the
Yep.
order of magnitude can get very fuzzy.
Yep.
Sometimes you would have grown faster, but if not for some sort of inventory delay here or there, I think it takes that human judgment there to know that we're not trying to play a quarter game here. And
Yep.
so giving ourselves and our companies enough time to kind of not think so much about the noisy quarters, but the story still stands over a 3 to 5 year period. And I think that's where selling too early kind of hurts you, is because, hey, bad quarter, should I get out? Versus, no, the thesis still holds.
Yep.
Nothing, all our channel checks are giving us the same answer. And so
Yeah.
you've got to like reestablish the IRRs of that investment and not be in a panic to sell. I think that helps us kind of maintain our investment and ultimately yields the returns that we're looking for.
That makes a lot of sense. So I'm imagining are you not rescoring all 100 variables in your scorecard?
Instead of change.
Say again? Say again?
Only focusing on the ones that have changed.
That are changing and keeping up to date on all those. That
Yeah.
makes a lot of sense. So I read your perspectives series on your website, right? And in that series, you propose that every business fundamentally solves exactly two problems: demand and supply. How does framing your fundamental analysis around these two primitives like simplify how you evaluate a lot of complex technology and industrial companies?
I think it's like a first principle. When I was writing that perspective, I just went back to my engineering roots and tried to like simplify what's the free body diagram here? What are the binding constraints and boundary conditions? And I think that's what I came up with, is like it comes down to demand, supply, and capital. And I think if I'm not able to clearly determine what are the demand drivers of a business, then I'll look elsewhere. I think smarter investors than me have said is like, rather than trying to, hunt a jaguar on a tree, you hunt, well, that's already limping. So I think sometimes we forget that you don't actually need to, find the biggest prize in the savannah to be a good investor. And so I think that discipline of, hey, this is what drives demand, and this is what defines the your supply constraints and your strengths on the supply side, ensures that the business is still within your circle of competence. I think when you invest outside your circle of competence, significantly outside your circle of competence, it can lead to not so fun outcomes.
This comes back to the Warren Buffett book on your dad's coffee table. That's a lesson that he did not understand technology, and so he generally stayed away from it for his whole career. Well, let's dive into AI. AI is a theme. AI and compute and all the associated things around it, or most of it, are some of the themes you're capitalizing on. How do you use AI and how you research? What are some of the ways that it benefits you? What are some of the things where it can blow up in your face?
Yeah. So I'll start with the last thing. I think we've still got a ways to go before I trust any evaluation model from AI. So that's something that still requires a lot of human judgment. Because
you're, as far as generating a financial model and things like that,
like, sure, it'll help us with a skeleton of sorts, but it's not. I'm not going to believe any numbers. It does so far. And that has more to do, I guess, with my style of investing. It's the human narrative thesis that you bring, you develop much before the model gets developed, is what ends up in the model anyways. Your expectation of what the next 2 years of growth are going to look like, it isn't the number that you're just like an AI or a human is putting in the model. It is the assumptions that the human made before when they were building their thesis. So, sure, for productivity reasons, we we have standardized models. So, AI is able to create them quite efficiently. But, we're still trying to like find a way, sort of a middle path where it's able to make some good assumptions that, we can cross test. And it comes down to even, the style of investing on structural inflection. I can guarantee you that you not see structurally inflecting businesses with any regularity, whether it's a model built by a human or a model built by AI. I might even go on a limb and say that most models have growth rates going down over the next 5 years, which is not exactly how a structural inflection should look like.
Should what? Yep.
So, and we've seen companies, especially in the AI space today, actually, beat analyst estimates by a mile on revenue growth because no one yet has a very good idea of how to model a structurally inflecting business. So until that happens, we'll keep that in human hands. But we've had an incredible journey with AI. So right at the get-go, when we started our fund, we made a choice that we want to be using AI from day one, right? And back in the day, we started with ChatGPT, sort of OpenAI. Then we moved over to Gemini, and now we're, I'd say, primarily a Claude and Gemini shop. So no question about it, huge productivity gains, right? In collecting materials, and also, the systems and frameworks that we've built, we've kind of embedded that within our preferences in our AI models. So it knows how to provide outputs that fit our framework, whether it's, how it categorizes intelligence signals, how it thinks about the different elements of our scorecard. So I think the human discipline of having those frameworks and scorecards in place make sure that the output from AI can easily fit into your workflow. So that was, I would say, how we were utilizing AI up till probably Jan of this year. I think in sort of the earlier months of this year, my thinking on AI shifted. I started asking this question, rather than make AI think like me, is that the right way to think about it? Or should I, I always think like me. Should I find a way to incorporate the unique way how AI thinks as into my workflow? And I try to define it in simple terms as, can I utilize AI or the intelligence within it to help me tell the difference between a long or a short? Number one, can it help me change my mind on my position size? Should I bet a small position or a large position on a company? And can it actually help me think about when I should size in or when I should not size in terms of timelines? Is it now or is it later? So if AI is able to help me with these three, what I would call directional vectors, I think that's alpha, because it's telling me things that I would otherwise not notice.
Yep. Also, I'm hearing in there that that if an AI thinks like you, it's essentially it can support your weaknesses as well as your strengths, and you want AI to see your blind spots, right? If it's just confirming everything you're saying, you could miss some things. Am I thinking about that right?
Yeah, I think so. And anyone who has utilized AI knows that it has a tendency to do that.
Yep, sycophantic.
Yes, so it's fairly supportive of your conclusions in different forms and shape. But I think the engineer in me was thinking about alpha per unit time, right? So if I think about alpha per unit time, AI is helping you definitely with productivity. So your time is going down. But what are some unique ways to deploy AI to increase the alpha? So if I separate out the numerator and the denominator, and I can find a way for AI to deliver on both, I can get exponential gains rather than linear gains.
Yep. One of my hypotheses about AI is the following. Let's take this away from you to ABC analyst. Let's say ABC analyst has a 60% win rate, right? There, for each of those things, those companies that he's evaluating or he or she's evaluating, there's probably a prospective return, price target, right? Timeline, right? One of the things I think how AI can increase alpha is you can actually analyze more companies. And then you can make a decision. Do I want to diversify into more opportunities? Or do I, let's say, you have an average holding of 20 companies, let's say. Or do I want to make sure those 20 companies are the opportunities with the highest alpha potential price targets, in gains, right? So I think it can help you analyze, do deep research on more potential opportunities. I think the other thing that AI can do is to help you do your cross checks. Like you mentioned, whether it's weekly, monthly, or even daily, it's testing your thesis. These 100 things in your scorecard. Let's test the ones. Are they holding true for, and giving you early signals that the winds have shifted, if you know what I'm saying, right? And I think those are. I think the third is help me see the blind spots. Here's my conclusions. What am I not thinking of? What risks? What world events and that could be different from that could counteract my worldview and make my world, like thinking about your strategy. That's how I would employ AI to increase alpha in sitting in your shoes?
Yeah, no, 100%. And I think we do it in different ways. So we don't think of AI as this monolith. So what we've done is we've kind of created a unique set of agents across different topic areas. We call it our AI stack internally. And so, our AI infrastructure stack, which is not open source yet, we have other ideas on if happy to go into the roadmap. But as it stands today, there are a couple of agents that are sector experts, right?
Mm-hmm.
So since it's, we're just a 2-person team, we don't have an army of 100 analysts to cover every sector with the depth that it deserves. I could have a biotech analyst, right? So we invest heavily in biotech but it takes a lot. You need to understand the clinicals and the trial results, but you also need to understand the science and the past history of every single or most of the important drugs that were created in a certain therapy area. So a biotech analyst could have all the data about, path-breaking trials and what was success, what did failure look like, what were the biomarkers in those results. It can also know the unique valuation methodologies that you need to deploy to understand a biotech company. And it can it's connected to the web. So it's able to pull information on any single company out there. So suddenly, you have the ability to not only boost your productivity because you're not doing all that data digging yourself, but also it can, you may not be familiar with a 1970s research paper that came out on a certain, rare disease out there that was, published in PubMed, but you didn't know about it because you can't search PubMed easily. And so I think that is what, we think about as, balancing both the time on research as well as sort of the alpha generating ability. Simultaneously, another, as you mentioned about, worldview, we've kind of taken a couple of path breaking frameworks, right? Whether it's the sort of the big debt cycle, leveraging from sort of the Ray Dalio school to sort of Marco Papich, who talks about geopolitical alpha in a constraint. What are the limiting constraints for certain countries to make certain socioeconomic choices? So all of that gets fed into our decisions around the worldview. So it informs, should we really be allocated to Europe right now? Or should we, park our money in Latin America? And then, sector analysts also help. And so you're kind of creating this network of analysts who are specialists at their own job, but you're setting up the plumbing between them. So the ultimate response is kind of a multidisciplinary informed view. And you can't really do that on a single run, on a single chat interface or a single model, because you'll just lose out of context window and we'll start hallucinating.
Yeah. It's one thing. AI has been trained on everything, right? Yeah. So when I was researching Strivepoint, I asked Gemini to scrape your website, read it, tell me all the important things I need to know, right? But be very clear, it did not do that. It will not do that. What it does, it's been trained on Strivepoint Capital. So it's telling me from its memory what I needed to know to have a good podcast with you. So it wasn't following my directions. But I think what the key point here to understand is that the main models have been trained on biotechnology analysis, been trained on various sectors, like of what a sector. So it knows it, but how do you make sure that it focuses on it? It keeps it in context, right? Because investment research is many faceted. Right. And the way we look at the system design here to create AI tools for investment researchers is how do you break out investment research into logical tasks and logical workflows and make sure that the right tools, the right content is used for each of those research steps. And then last but not least, how do you keep it focused on the task at hand? You keep the context windows as small as possible for high fidelity outputs at each of those steps. So it kind of sounds like that's the way you're building your technology stack. And is that true?
I think like as one version of what someone would call this is like post-training reinforcement learning, right? So it's like the model out the frontier lab, or if you're using an open weight model, is trained to be a general purpose intelligence solution. But general purpose is not great where like in an industry like ours where alpha is heterogeneously distributed.
Yep.
So if you want to really capture alpha that's heterogeneously distributed, you need a heterogeneous.
So you are actually training it and having it read and understand content that you think it's important to be a biotechnology analyst and things like that. Fantastic.
And so we took the model, we deployed it as a skill, or it has a data set within it. and it's been trained to respond, and it knows what good looks like. What whether we call it like post training RL, or we call it like few short example based training. So we do a lot of that before we can say, okay, this capability is ready for prime time. And we built a lot of very individual skill set, right? So we have a red team, for
Hmm.
example, AI red team. That's where we're putting in our thesis elements, and its sole job is to break it. And so it's incentives. Its token incentives are in a different direction. We might have someone that's only focused on the long, another that's focused on the short, and you can make them sort of function without actually building all the AI infrastructure that some of the frontier labs had. You get your poor man's answer on sort of a adversarial model, where you've got AIs kind of trying to compete and debate with each other so that you get the best outcome out of it, or get the best kind of way to interpret the information out of it.
Yep.
And then sort of extending our roadmap into some of those feature sets. Eventually, we're still as I mentioned, we are primarily using Claude and Gemini, but over the long haul, as we scale, an open weight model might be a better answer for us. It isn't now, but but these experiments and these kind of evolutions that we've made around our utility of AI will definitely inform how we eventually do that. And the last thing I would say is, sometimes when you're a human analyst, there are two things that can work against you, and that is when you're missing context from a pattern you saw a long time ago. Humans are great at pattern recognition, but not they don't have 100% recall. That's where
Mm.
software helps. And the second is implicit assumptions. Since we are sector agnostic, we might be making bets that implicitly mean certain things for one sector versus the other. If I am
Hmm.
long energy, what does that mean about all the AI build out participants who are energy constrained?
Hmm. Well,
And
that would benefit them, right? If energy goes up, right?
not really, because like
No?
a lot of the AI players right now don't have access to grid power. The interconnection queues are growing. They
Yeah,
are desperate for energy.
yeah. Well, it does energy outpace the energy growth underpace or outpace demand, right? If it outpaces demand, then they're fine, right? But
Exactly. And
yeah,
so I think those factors will also be hard for a human to find out. Like, I give you, this is a fairly easy example, but there might be many more complex implicit bets that you're making when you're investing in a certain sector or position that has ramifications for other names in your portfolio.
yep,
And I think, finding those implicit connections can take, a human can do it, but it takes a lot of time. And so if you can get AI to add both that alpha and that productivity, suddenly, that's where the exponential kind of adoption and kind of utility comes in.
that's fantastic. Wow, this was a wonderful podcast. I feel that you have a very unique approach that I haven't heard before. And how should I think a lot of people are looking at inflection points, but I haven't seen someone that has incorporated AI to the level that you have that I've interviewed. There are others that are doing similar things, but I shouldn't say similar things. They're incorporating AI pretty well, but you made a clear case for the benefits in a way that others have not. So this was fantastic. I loved your story, your journey, and I really appreciated you being on the pod today, Akshay.
Absolutely loved speaking with you, Ben, and it was a total pleasure over the last half hour or so. Full hour.
Yeah, well, thank you for joining. How can people find out about your firm?
You can learn more about us on our website, our LinkedIn page. Our website is strivepointcapital.com. Leave us a message if you're interested. And we also have a LinkedIn page with the same name. You can find me at, Akshay Rao at Strivepoint. And looking forward to chat with anyone interested in what we're doing.
Fantastic. Well, thank you, viewers, for joining this Scaling Alpha podcast today. Hope you learned as much as I did. And until the next one, hope everything is great with you all. Talk soon.